Hey everyone, and welcome. Today, we are diving into a topic that sounds, super intimidating, but actually affects millions of people working across borders: double taxation. We're going to break it all down, and I promise by the end of this, you'll know exactly what's going on and how to handle it. Let's get into it.
So let me ask you, are you a freelancer with clients in a different country? Maybe you're a digital nomad working from somewhere new and exciting. Or, hey, maybe you're an investor with shares in a foreign company.
If any of that sounds like you, then I bet you've had this nagging thought in the back of your mind. Wait a minute, am I going to get taxed twice on the exact same money? And look, it's a totally valid fear.
That fear, that exact scenario, has a name. We call it the double tax trap. But don't worry, the whole point here is to show you what it is and, way more importantly, how you can sidestep it.
So what is it really? At its heart, double taxation is actually pretty simple. It's just when more than one country says, hey, we have the legal right to tax that specific income. You can almost picture it like a jurisdictional tug-of-war with your money stuck in the middle. Let's use a quick example to see how this actually plays out in the real world.
So, this is Liam. He's Canadian, but he landed this awesome 6-month contract in Germany. He went, did the work, earned a solid 50,000 euros. Now the job's done, he's back home, and it's time to deal with taxes.
And this is where the trouble starts. Liam suddenly finds himself in a really tough spot. Germany says, you earned that money here, so you owe us tax. But then Canada says, well, you're a Canadian resident, so you owe us tax on that money too. How on earth is that even possible?
Well, it's not a mistake or some weird glitch in the system. It happens because of a fundamental clash between two completely different philosophies of taxation. And understanding that clash, that's the key to all of this.
Okay, so here's where it all goes sideways. On one side, you have Canada, which uses residence-based taxation. Their logic is pretty simple. Liam, you're our resident, so we get to tax all of your income, no matter where in the world you earned it. But on the other side, Germany uses source-based taxation. Their logic is just as simple. He earned the money here in Germany, so we get to tax it at the source. And just like that, you see the problem. Under their own laws, they're both right, and poor Liam is caught right in the middle.
So who cares, right? Why does this really matter to you? Well, if you just let this happen, it hits you directly in the wallet. It just shrinks your take-home pay, it can seriously slow down the growth of your investments, and it can even start to influence huge life decisions like where you can actually afford to live or work. It makes being proactive and planning ahead absolutely critical.
But, and this is a big but, here's the good news. Countries are not oblivious to this. They know it's a huge problem, so they've actually created a kind of toolkit to provide relief. And it mostly comes down to two main tools. Let's break them down. All right, tool number one is the exemption method. This one is really straightforward. Your home country basically just pretends that foreign income doesn't even exist for tax purposes. You pay your tax in the country where you earned it, and that's the end of the story. Simple. Now, the second, and honestly more common tool, is the credit method. With this, your home country does tax your worldwide income, but then it gives you a dollar-for-dollar credit for the taxes you've already paid to the foreign country. The end result? You end up paying a total amount of tax that's equal to whichever country's tax rate is higher, but you never ever pay tax on the same income twice.
Okay, so we have the tools. We have the exemption method and the credit method. But how do you know which one to use for which income? That's where the instruction manual comes in. And that manual is called a tax treaty. These agreements are what make the whole system work without chaos. The best way to think about a tax treaty is as a formal rulebook that two countries have agreed to follow. Its entire reason for being is to solve this exact problem, to sit down and decide officially who gets to tax what and when. It's all designed to give you clarity and prevent you from getting caught in that crossfire.
So what are you actually going to find inside one of these things? Well, a whole bunch of crucial stuff, actually. They have tiebreaker rules to figure out your main tax home if you split your time between two places. They often have rules that lower the taxes on investment income, like dividends and interest. And, most importantly for this conversation, they spell out, in black and white, which relief method, credit, or exemption you're supposed to use.
Okay, let's make this real with another quick example. This is Oliver. He's a US citizen, but he lives in Portugal. Now he also has a bank account back in Germany that's earning him some interest. Normally, Germany's domestic law would require them to withhold a pretty big chunk of that interest for taxes. But because a tax treaty exists between the US and Germany, Oliver gets a huge break.
Thanks to that treaty, the German withholding tax on his interest gets slashed all the way down to just 10%. That is a massive difference. That's real money that goes right back into Oliver's pocket, all because of that one specific agreement between the two countries.
All right, we've talked about the problem, we've looked at the tools in the toolkit, and we've got the instruction manual. Now let's pull all of this together into a simple, actionable checklist that you can actually use.
Here it is, just 4 steps. First, be crystal clear on what country considers you a tax resident. Step 2, make a list of every single country where you earn any income. These are your source countries. 3, and this is the absolute key to the whole thing, you have to find and check the tax treaty between your residence country and each of those source countries. And finally, step 4, you apply the relief method, either credit or exemption, that the treaty specifically tells you to use. That's it. It's your roadmap to making sure you pay the right amount of tax and not a single cent more.
So when you step back and look at all this, it really boils down to one big question for you to think about. Are you actively managing and optimizing your global income, or are you accidentally leaving money on the table? The good news is, now you have the tools to figure that out. Thanks so much for joining me.